All right, well, let's get going here. Good morning, everyone. Thank you for joining us for our third quarter update and outlook. I am Brad Long, Managing Partner and Chief Investment Officer. Our compliance team could not be with us, our legal team could not be with us today, so they'd like to get us to some disclosures. But beyond that, I have Michael Sustarsic, Partner and Research Director, here with us today. So the format of today's call, typical, we're going to have 30 minutes. We got a lot to cover. We'll move quickly. There will be a recording if you'd like to see it afterwards or you want to hit pause or take some notes. That's always available. The front half of the call, we're really going to focus on Q3, key themes, and things that are influencing markets year to date. We will probably be notably light on things like Outlook 2025, because as many know, we're about to get into our asset allocation season, if you will. We're updating CMAs. We'll be releasing our 2025 outlook and bringing our kind of new positioning to clients in the coming months. So because we're on the precipice of that, we're not going to front run that process at all. So we'll be a bit lighter there. In lieu of that, we're going to spend a decent amount of time with Michael on the line talking about private markets, key themes that are driving trends there. And as we know, with private market data, it's always lagged. So we get an opportunity to look back kind of halfway through the year and take a deeper dive onto really what we should be knowing about and positioning ourselves for in 2025. Format wise, again, if you have questions, put them in the queue. We'll try to get them as we go. If we don't, we'll reserve a little bit of time at the end if we see the queue building. If not, maybe we'll end early or right on time without additional questions. If there is something that you want to know that we're just not able to get to, give us a call, write us an email, call your consultant. We're happy to set up a call separately, go through that, and address whatever questions you might have. So with that, we'll go ahead and begin and kind of get a view into Q3. So, for those that kind of took the sell in May and go away approach to, kind of Q2 and the beginning of Q3, you would have missed quite a bit. It was a pretty interesting quarter. July, August, and September, early July, the Fed really decided to kind of, fan the flames of anticipation. They decided to hold rates steady at the July meeting. July 11th, I think it was, we had good CPI data falling 0.1%. Super core, remember that's sans housing, because there's a little bit of noise there, and CPI was running at 1.8%. So the market effectively had said, hey, you have an open window to start decreasing interest rates. And the Fed said, you know what, we're going to wait a little bit longer. As July continued to progress and into early August, we continue to have a pretty good earnings season. We'll talk more about that in a moment when we talk about valuations here in the United States and elsewhere. But as we were looking at July, earnings season coming in, 11.5% earnings growth. That was the highest since COVID. GDP now for Q3 was, around 2.5%. So the markets were really saying, hey, Fed's on strong, or economy's on strong footing, inflation's on its back foot. The Fed really needs to step in here and start lowering rates. End of July, we started to see, escalating tensions in the Middle East, Israel expanding their attack, killing key Hamas leaders. They, were increasing attacks on Yemen and literally Iranian soil. We saw some poor manufacturing data in early August. I think it was August 1st, where you had ISM manufacturing data at 43, so well below 50. 50 above 50 is expansion, below 50 is contraction. We saw some weak jobs data. I think it was 114,000 jobs, well below expectations in early August, and that put the market into a bit of a tailspin. Is too strong of a word, but really started to come off risk appetite. The conversation shifted to from soft landing to hard landing. The Fed is over tightened. We've waited too long. We've kind of missed our window. That coupled with elections, and frankly, something that's probably already fallen out of the lexicon of many investors, the carry trade in Japan. I think it was August 5th. Japan had its worst trading day since the 1980s, with falling intraday over 10% as kind of yen dollar carry trade was unwinding. You can tell that there was a lot of pent up tension in markets, and markets really sold off in July. I'm sorry, July through early August. Now, as we progressed for the rest of the quarter, you can see a lot of green on the screen, right? The rest of August, the rest of September were fairly sanguine, even though market expectations for rates continue to be anchored. And we know ultimately in September, we did get a 50 basis point cut from the Fed. So what did that mean on a net basis for the quarter? So long duration assets outperformed. The ag outperformed cash by 400 basis points. We have circled here, long bonds, right? The most expressive version of duration up over 8%. Also in the quarter, we saw small caps pretty handedly beat large caps, not just on the basis of small caps did very well. For the quarter, they were up 9%. But you saw some moderation in the S&P 500 and specifically within the Mag 7, which is a bit of a new trick here for Q3 within large caps. Anything rate sensitive certainly took advantage of lower expectation of rates. So REITs being a rate sensitive asset class up 16% for the quarter. You can see basically Q3 made the year for REITs. Up 16.1% for the quarter, up 15.9% for the year. So they were basically flat year to date. Q3 happened. Now they look like, kind of a top three asset class for the year. And, if we're, again, take the time capsule of September 30th, we would say notably a non-mover was really energy, specifically commodities and oil. With what we mentioned previously with escalating tensions in the Middle East, Iran, obviously now explicitly engaged in military action with Israel. Iran is the world's fourth largest producer of oil. They produce about 10% of the daily, barrels on average. And so to the extent there is a disruption of that supply, that obviously could have, a bid, all else equal, demand being flat, lower supply equals higher prices. But oil was effectively flat over the third quarter. WTI was trading at 67, Brent at 71. You really did not see a move there. Now, we would say two things. Again, putting the fence on September 30th, it's October 10th now, so you can read the future a little bit. Two things happened. One is generally there's this narrative around demand. Can the consumer, on perhaps a bit of a stretched basis, continue to spend at the rate that they're spending? So that's kind of a recession-ish or consumer out of, I guess, proverbial gas, if you will. Pardon the pun on talking about oil. But if the consumer is running out of gas, demand is slipping, and so oil prices are not rising. The second underlying component there through Q3 is Saudi Arabia in particular, but OPEC Plus in general, moving away from price protection, usually calling that $100 a barrel level as the right level for price, back towards market share. Frankly, Saudi Arabia is, I think, sick of cutting supply and letting Russia sell their oil on black market for higher prices. And so they were moving greater supply into the market, which was keeping prices down. Now, as we expand beyond September 30th, we have seen, with some of the expanded actions, in the Middle East, now WTI and Brent trading up towards 77. So starting to price in a little bit more of that geopolitical risk and uncertainty around, escalating conflict in the Middle East. Big news for the quarter, obviously, was the Fed coming out. There was a lot of, if and when would the Fed cut. Now we know that they've cut, and not only have they cut, but they cut by 50 basis points. So let's put a little context behind 50 basis points, because while it's not unprecedented, it is, somewhat uncommon to really start a cutting cycle on 50 basis points, especially with the context that we have today. I just described low unemployment, fairly robust economy, GDP continuing to grow, inflation moderating. Usually those are not environments in which the Fed is feeling the need or kind of pressure by markets to move rates down more quickly. Admittedly, they would probably say they should have gone in July, but they were holding off. This is Powell wants to be Volcker, not Burns, meaning he doesn't want to cut rates too early, reignite inflation, and then have to start another rate rising cycle. As you can see in the past, though, rate cutting cycles vary substantially. The average cutting cycle, again, averages kind of give you some context, but it devils in the details. An average cutting cycle is about 24 months. Cumulatively, there's 12 cuts across those cycles. But as you can see, as we go back to the 1980s, and we'll punch that one out for you a little bit more in a moment, the first rate cut in the 1980s, it was April of 1980, was 900 basis points. Clearly not a world in which we live today. The Fed funds rate at the time was 17.5%. A 900 basis point or 9% cut, is aggressive, but perhaps rational when rates are nearer to 20%. The last few times that we had a 50 basis point cut, fairly ominous time periods. You have January '01. That's the deflating of the tech bubble. You have September 2007. We didn't necessarily know we were on the precipice of the GFC, but we certainly were. And then March of 2020 was the Fed was guarding against, we'll do whatever it takes, as we were manufacturing a recession from COVID and really shutting down the economy with shelter in place. So as we punch into that a little bit more, I think one of the unfortunate things about, the Fed cutting rates more aggressively out of the gate is, what I lovingly call, as I have young boys at home, kind of the if you give a mouse a cookie effect, right? The Fed was asking, or the market was asking for 50. The Fed gave it to them. And then in doing so, they said, in Powell's interview, in their minutes, even they had dissension. It was a unanimous cut. They said, we went 50, but don't expect this, to stay on this train. We're probably going to be moving back towards 25 is the interpretation of, kind of the more aggressive cut, but dovish comment. These are market expectations of Fed policy, the Fed funds rate, as of December of this year. So again, this isn't what will happen. This is what the market is betting on. So this is December 2024. And as you can see, current policy at 475 to 500. So that means basically the highest probability is set that we're looking for 3 rate cuts over the next 2 meetings. So that would be at least one 50 basis point cut and one 25 basis point cut. Moreover, if you look at kind of the smallest bar here, looking at 4 cuts, right? So cumulatively, you got a 62% chance as you add these 2 bars together of at least one or more 50 basis point cut. Now, again, stepping outside of the time capsule of September 30th, the market has shifted a little bit more back to the left here. We had really strong jobs data last week. I think there is going to be a lot of noise in jobs data. So just a warning or FYI for consumers that love to read the CNBC headlines or be out there in the news. We have a large dock workers strike happening across the entirety of the Eastern Seaboard. We have the Boeing strike in the Northwest. There are things that are going to influence near-term jobs data and produce noise, perhaps, if not volatility in those numbers. So I wouldn't get caught up too much on recent jobs data or what will come. But nonetheless, the market has kind of moderated this. If you give the mouse a cookie, they're going to ask for a glass of milk. Now, as we're nearing towards December and we're thinking about the end of the year, I will say, as you're pulling together your Christmas wish list, be wary of what you wish for, because in past periods where the Fed has been cutting and cutting in a material way, 50 basis points or more, and right, not unprecedented, like we said, but it's less common. Those are times in the market where the Fed is needing to move in at the defense of labor, right? Inflation is less of an issue. Now you have rising unemployment. If the Fed has to be cutting by 50 or more multiple times between now and call it the beginning of next year, it's not because inflation is benign and unemployment is at 3% and they're just very happily cutting at 50 or 75 basis points. They would more likely be programmatically or systematically doing that in 25 basis point tranches, slowly getting back to what's called the neutral rate, where their foot is no longer on the economic brake pedal, which is where they are now, nor on the economic gas. They're trying to coast into neutral and let the market grow as it may with strong employment and GDP. If we're in a position where the Fed is feeling the requirement to cut by 50 basis points, by 75 basis points. That's an environment in which it's defensive labor, and it means we more likely have a recession. So be careful what you wish for. And I think market expectations are probably more realigning a bit towards that more modest positioning. Now, zooming in here in the United States, it's been a very strong year. We're talking about 20+% here returns in the United States. S&P forward earnings here trading at about 3 standard deviations wide. Now, I know there are a lot of consumers of market data. You'd say, hey, the complexion of the S&P looks different than it did in 2004, and the earnings per share growth is growing faster in recent years than it has, so it should demand a higher price. All of those things are true, but it is still holds true that 22 times forward is an expensive price. Both of those things we can hold both of those thoughts simultaneously in our mind. Now, what's interesting about 2024 is that as we look at the decomposition of what's been driving markets, it hasn't just been this tailwind of investors just wanting to buy more and more at more expensive prices. It's been a strong earnings year. If we break down the decomposition of what's driven the S&P by earnings growth and multiple growth, it's basically neck and neck. They're identical in what has been driving markets. And so we mentioned that 11% plus earnings per share growth in Q2. It has been a strong earnings year, and so it is a healthy thing to see this balance between earnings kind of playing catch up with multiple expansion. That's what's been driving markets. The unhealthy version of this is, earnings effectively are flat or negative, but multiples continue to grow and the valuations increase, right? Things become more expensive. The healthier version of this would be, multiples are flat, earnings are the primary driver, and valuations are coming down, that making markets more attractive. So despite starting the year fairly expensive, valuations have not gone extremely more expensive because it has been a very substantial growth in earnings year. Now, I know I said we were not going to talk too much on outlook, but I will kind of tea leaves a little bit into 2025. Expectations for growth are fairly high. Today, operating margins in the United States aren't at peak, but they're fairly close to peak. So that will probably be an important center of discussion around our 2025 allocations and our ability to meet those expectations and continue to grow into these multiples. Speaking of multiples and relative valuation, in the mid-year, we talked a lot about relative valuations here in the US and outside. Emerging markets, have been a lot less expensive in the United States. Again, price is not, or valuation is not the only component of investment, but it's a great place to start. Trading at 12 times instead of 22 times forward earnings. We bring this up too because Q3 was an interesting time period here for China. China, because of its rally in Q3, also with a continued in October rally, is now year to date the best returning country, of kind of major countries, both in US dollar and in local terms in yuan, nearing 30%. China in Q3 really looked to instill some animal spirits in investors there that had called this COVID hangover, whether it's from overbuilt and property, savings remaining high and consumers not spending. Domestic consumption has been in somewhat of a slump. They came out with a three-pronged approach. They cut their equivalent of the Fed funds rate. They put in some pretty aggressive programs where they were trying to take out material supply and overinvestment in real estate, buy those vacant properties, use them for low income housing. So they were really putting their foot on the gas and trying to instill in the China consumer, now is the time to spend. Let's get back after it. And markets have reacted pretty material to that. And so you've seen, China really move ahead pretty materially here in not just year to date because of Q3, but has continued that run in Q4. Now, it's important to note that the volatility we saw in July and August, right? Volatility is kind of the ugly or evil cousin, if you will, of opportunity, right? Without volatility, we do not create opportunity. This is just that FYI chart on, remember, since 1980, the average return of the S&P, almost 13% on a calendar year basis. intra-year volatility, coincidentally, something very similar to what we saw in July and August, is a drawdown of about 10%. So volatility is normal. It's a necessary evil in investing in markets. And so while we don't like it, right, we should position with the notion that it is an inevitability. And that's why we build portfolios the way we do with the diversification that we do. And then finally, before we transition into our private equity discussion, we are, just a handful of weeks here ahead of the 2024 general election. We've written about this, we've talked about this, we've talked about this on the podcast. We've kind of shouted it from the mountaintops. Elections are about promises, not policies. They are not particularly predictive about market outcomes, whether you're green, whether you're blue or red or somewhere in between. If you're green, maybe that's great too. But we know that elections tend to elicit emotions in us. They are designed to do that. They are marketed to do that because they want us to get up out of our seats and go to the polls and vote. That's great. When the election time comes for the election, get out of your seat and go vote, but just don't go back to your computer and then start trading in your portfolio. We use this chart as kind of an overtime piece to just show, markets are not indifferent, right? Elected officials create policy, policy creates reverberations. There are things like tax policy, which are going to be important in 2025, deficit, decarbonization, foreign policy, right? These are all material issues, but we can't be using the pre-policy or the election to consume that information to then make judgments about how we should be reacting in markets. So just remember, portfolios, markets have done well over time. Now we're going to show you a couple of numbers here. And I will say this isn't an original idea. We kind of stole it from our friends at Schwab. But if you were investing and you are a ardent, just say Republican, moreover, you think, I'm a Republican, but whatever the Democrats do, I just don't believe in. And you invested in 1960 and you invested $10,000. You would have a portfolio that accumulated in value to $102,000, right? So 10,000 to 102, that's a big move. Let's say you're the inverse of that. You're a Democrat. You say, hey, I just only believe in democratic values. I only think markets can succeed under the executive branch in which a Democrat is in the seat. Well, your portfolio would increase in value from $10,000 to $500,000. Now, a self-serving politician, especially of the Democratic Party, would probably stop the presentation here and just say, look, I told you Democrats win, Republicans lose. That's not what this data shows, and it's evidenced by the third point here. If you were indifferent to party based on how you invest your portfolio and just invested throughout the entire period, your portfolio would have grown to $5.1 million. Not even a comparable basis. Now we're using these numbers in a bit of a manipulative way because this isn't saying who's better as a Democrat or Republican. What this is saying is time in the market is far more important than who sits at Pennsylvania Avenue. So as we near November, and again, emotions are high and we feel motivated to get out and vote, go out and vote, vote for what you believe in, but just don't come back and make trades in your portfolio because it doesn't end up being a positive outcome typically when we invest on emotion. So that is our kind of Q3 year-to-date quick update. And now we want to transition and spend more time with Michael and really get into some of the key themes that are driving private markets. So that's private equity, private debt, and things that are coming through and what we should be thinking about as we're positioning for 2025. So again, if you have questions, just put them in the chat queue. And Michael, with that, we'll turn it over to you.
Awesome. Thanks, Brad. And I'm sure some of us are all some shade of green just from being sick of the political ads that run this time of year. I at least know us in our household. We are that shade of green right now. So would love to dive into this. A lot of these topics, frankly, Angelique, our colleague, just authored a great paper that was published a few weeks ago. A lot of these topics we also discussed at our investor conference a few weeks ago as well. So really want to dive into a few of those. So the first topic really here is just capital raising and fundraising in the market continues to be depressed from the levels we've seen over the 2020, 2021, early 2022 period, and continuing to come down. I think as notable, and keep in mind this data is a little lag, so it's Q1 right here. And so expectations and more recent expectations are that we get pretty close to the same level we were at last year. But as notable as just the dollar amounts here is two things. One, just the number of funds that are being raised. And so that has fallen dramatically. It means average fund size is getting larger. And then the median time to raise a fund is sitting just over 18 months now. So just over a year and a half. That's up from under 10 months a few years ago. And so it's taking groups about 80% longer, just quite a bit of time to get to that final close and print those numbers that fall into here. And it's largely a function of LPs taking their time. It not being as easy to raise capital as it was during the 2020-2021 timeframe. And so that's I think a big component that's looking under the hood there. And as we see, maybe just to double click a little bit on the types of funds and kind of where the capital is being raised, you're seeing three areas that are pretty consistent. So buyout, secondary, and credit funds. The fundraising activity is still there and pretty consistent with years past. Where it's down dramatically has been around real assets and real estate, as well as venture capital. And we think there's a pretty clear correlation between where commitments are going today and where there's an expectation or a greater expectation of capital coming back more quickly into the future. And the distributions or lack thereof has been a pain point for a lot of LPs as we scan the market. So as we flip to that, buyout, a core piece of most and almost all private equity portfolios, the expectations again continuing to rise for liquidity there, either via exits or dividend recaps. Credit has a strong cash flow component. So again, distributions coming back a little bit more rapidly there. And then secondaries also have that expectation of a quicker return of capital, typically buying in to a fund a little bit later in life, expectation for that capital coming back quickly. On the flip side of that, where we're not seeing the exits today and where you're not seeing capital flow from a commitment standpoint, within the real assets and real estate space, just an immense amount of uncertainty still. And very broadly, it's a very rate sensitive environment. 50 basis point cut helps, but it doesn't certainly take us back to where things were. The cash in refinance is still the same thing, and some GPs and sponsors having to be creative in how they're staying afloat there. And then venture capital, really not a lot of meaningful liquidity on the horizon, and which is a little surprising. We can see in this graph that Brad has on the screen, kind of the public listing avenue for 2024 has opened up a little bit relative to 23 and 22. But it's still pretty narrow, certainly compared to what we saw in 2021 and 2020. And so, with that, with the markets where they are, you would almost expect more liquidity from that avenue, and particularly in venture capital, which is a pretty normal exit path for them. But still, just a lot of heartburn from LPs, a lot of valuations that are still being flushed out, and also venture-backed companies that don't feel like they're quite ready to list publicly yet, given the shakeup that they've had. So I think we continue to see, distributions as being light for a little bit of period to come, but is also a large leading indicator in kind of where capital is going to be freed up and committed into the future. And the last thing I'll point to, I think it's obvious from just these slides, something we talked about in the annual paper earlier this year as well. But the farther we get away from the 2020, 2021, early 22 timeframe, the more those charts start to look like an anomaly as opposed to a trend that was taking off. And so the market is definitely, while it's come back in the year over year numbers and growth metrics from those very, very hard comps look probably a little bit worse than they are, as we're just really kind of resettling back to long-term averages. And so as we flip here, we're going to transition, kind of explain the past and what we've seen to look into the crystal ball a little bit. So as we've seen kind of where capital has come in, and this is the data you see on the screen is around the buyout space and private equity. Um, the capital that's been raised has not been uniform across fund sizes. And so we can tell a little bit just based on, where capital's been raised, where dry powder is sitting, where that dry powder is going to be invested. We can overlay that with the triangle you see on the right side, which is really what the private company count is within the US. And these are companies north of $10 million in revenue. So a substantial company that is very active for private investment. And what we see is on the top half of that, 81% of the capital raised is chasing 16% of the opportunity set. And then on the flip side, you've got a small fraction of the capital that's chasing a much larger opportunity set. And really, this is a pretty simple supply and demand graph as an equation as we break down to it. But what is this going to equate to in terms of the market and the opportunities that will be there? On the lower end, it really means that we're going to have better entry multiples, things that are not highly intermediated. Again, a little bit of capital chasing a lot of opportunities. On the flip side, on the upper end, there's a big scarcity premium in terms of the number of opportunities that are there. So all that capital chasing it is going to see a lot of competition around each other to buy those deals. You're going to have things that are priced much more to perfection. And then on top of that, if those companies are just growing at market rates, levering market rate growth in today's environment with interest rates where they are, isn't nearly as accretive as it has been for the period from call it 2010 to 2021. And so it's going to be much harder to come by those returns if the strategy is leverage market rate growth. On the flip side, a lot of the small businesses just also haven't been professionalized. And so there's, maybe for lack of a better term, there's some low-hanging fruit to be able to improve the business, catalyze revenue, really grow margin, and enhance earnings in a material way. And so those are things that if you're partnering with operating proficient groups that know how to move the needles in a business, and we see this from the data we have today, a great kind of upmarket stream to sell into when those businesses are ready for sale. And so we think kind of over the next decade, it's more and more about what you own in the market that's going to separate it from a performance standpoint and lead to outperformance, as opposed to if you just own the market. For the past decade, owning the market has been good and good enough for a lot of folks. In the future, we think kind of what you own is going to make a much greater impact in terms of performance and ability to outperform in a space that's only becoming more competitive.
Michael, we had a question on private debt, and I know we're running up on time, and we actually did have a slide on that. So maybe we can jump to that quickly. You can give us quick thoughts on kind of current environment on private debt, and we can wrap.
Yeah, absolutely. And so with private debt, Brad, I don't know if you want to pull the slide back, the slide up on there, just because it had a couple of unique data points there. But just a little bit of this is the impact the rate rise has had on the quality of private debt. So you see on the left just interest coverage ratio. Dark blue is interest coverage ratio below 1 time, so actually struggling to cover your interest payments. Light blue is above 1. You saw as interest rates rose, that kind of ratio is almost flipped. So there's a lot of companies that are just below that, or maybe materially below that 1 times interest coverage ratio. For reference, the debt service coverage ratio on just the high yield index today is almost 4.5 times. And so you're seeing a drastic difference in just underlying credit quality of the two spaces. And then kind of further on the right side of this graph, this is a longer term graph, but covenant light is really what the market is today. And so, when private debt was just entering the market, it was not as big. Covenant light was not the norm. Today, over 90% of the deals are there, and has just become the norm.
So conditionally, perhaps some investors not knowing exactly what's under the hood from the kind of probability of default, and then even if default, like what recoveries could be seen there relative to the public market. So that's a good takeaway. I know we're up on time here. We appreciate everyone joining us. A couple of quick things. You can expect over the next couple of months some things from us. We will be releasing our 2025 outlook in early December. So keep an eye out for that. We'll be holding kind of that rollout and this next equivalent WebEx in early July. We'll be sending those invites out over the coming months. So we appreciate you carving out a bit of time for us. Again, if we have any questions that we didn't get to, feel free to reach out to your consultant, and we appreciate everyone for taking the time. Thanks so much and have a great day.